All right, so we've made it to the final chunk of our monetary policy videos. Now we're going to look and see how monetary policy impacts the aggregate demand curve. So the goal with monetary policy, or like we'll see in the next chapter with fiscal policy, is closing the gap. Closing the gap between our long run and short run equilibriums. Okay, so if you remember from a couple chapters ago, we've got this long run aggregate supply, which is a vertical line. We've got an upward sloping short run aggregate supply and a downward sloping aggregate demand. And over here, we've got a price level. And down here, we've got real GDP. So a recessionary gap or an inflationary gap happen when the economy is not at that long run level of GDP. So let's say here, right, we have a short run equilibrium that's below our long run. So let's say in the short run we are at let's say $19 trillion. But our long run potential is 20 trillion. So the difference between what we could be at the long run and where we actually are is this gap. Okay, so the short run equilibrium happens where aggregate demand, AD, and short run aggregate supply intersect. It doesn't have to be at that long run equilibrium, as we talked about before. So a recession is any time we're producing less than that long run equilibrium. An inflationary gap is going to happen anytime we're producing more than that long run equilibrium. And so the Fed is going to use monetary policy to try to close this gap. The goal is that they want the economy to be at this long run equilibrium where all three of these curves are intersecting. Okay, so they're going to try to close that gap. So closing an inflationary gap means the economy is overproducing and they want to shift aggregate demand to the left. Okay, they want to reduce economic activity. Closing a recessionary gap happens when the economy is underproducing. They're trying to increase aggregate demand, stimulate the economy, right? Stimulate economic activity. They're trying to shift aggregate demand to the right. So that looks like what we have up here on this graph that I drew. So they want to close a recessionary gap. They want to increase aggregate demand. They're trying to stimulate the economy. So to stimulate the economy, they're going to practice expansionary policies, expansionary monetary policy. The goal is to increase aggregate demand, okay, or shift it to the right, and close that gap. We are trying to produce more stuff, get the economy to increase production. This is going to happen when the economy is below that long run level of real GDP and experiencing a recession. Okay, so expansionary policies. So open market operations, they're going to buy treasury securities. This is going to increase the money supply. Which then lowers interest rates, which then increases spending. So an expansionary policy is going to cause aggregate demand to shift to the right. Now, if you remember, aggregate demand is made up of consumption, investment, government spending, and net exports. So when interest rates go down, it changes the cost of borrowing, and it changes the opportunity cost of saving and spending. Okay, so cost of borrowing. If the interest rate goes down and you want to buy a house, home loans are 2% interest for 30 years. or you want to buy a car, right, and get 3% interest for, 6 years on your car. You're going to buy more houses. You're going to buy more cars. You're going to borrow more money because the cost of borrowing has decreased. It's cheaper to buy a house. It's cheaper to buy a car when interest rates are lowered. And so consumption is going to go up, right? Consumption is going to go up when interest rates go down. Likewise, investment is going to go up because the cost of borrowing is dropping. If I want to expand my business, it's going to be cheaper for me to get a loan. It's going to mean that my investment is more profitable in the long run because I didn't have to spend as much. Or if I'm using my own funds to pay for it, maybe I'm not getting a loan, it means there's a lower opportunity cost, right? Rather than saving that money for the future and earning a very low interest rate, I could be investing it in something that's much more profitable in the future. So expansionary policies are going to shift aggregate demand to the right. So buying Treasury securities increases the money supply, lowers interest rates, which cause consumption and investment to go up. It also causes consumers to spend more because the opportunity cost of their savings has changed. If interest rates are really low and you're not earning money from your savings account, maybe you're earning 2 or 3 pennies a month, it's like, well, I might as well just spend it now. Go on vacation, buy a car, go shopping. I'm not really earning money when it's sitting in my savings account. Another expansionary policy is they can lower the discount rate. So they're going to charge banks less for borrowing money. Right? They're charging less for borrowing. And so banks are more likely to lend out a greater percentage of their deposits because it's going to be cheaper for them to borrow if they need to. They're also going to lower the interest rate on reserves. So they're going to pay less for banks to save, pay less for savings. This also increases the incentives for banks to lend out more money. They're not going to be earning much interest leaving it at the Fed bank account, so they would rather lend it out to customers, do home loans or individual loans to increase the amount they can earn. For a long time, after 2008, the Fed had a policy of quantitative easing. So we have an entire topic page on that in Canvas, so I'm just going to briefly mention it here. But quantitative easing is where they increase the money supply a lot. They increase the Fed's assets, right, their balance sheet quite a lot. And this happens when rates are near zero. Because once interest rates hit zero, they can't really lower it anymore, right? They can't do much more to stimulate the economy. So they created a policy of quantitative easing where they said, we're just going to flood the market with money supply, with liquidity. This is going to be a signal that we're going to have long-term, easy money policies. But see the topic page for more details. Okay, so here's what it looks like on graphs. Okay, so we start here at panel A, and we're at this equilibrium where we're below that long run potential. So the Fed is going to buy bonds. So the demand in the bond market goes up. This increases the price of bonds, which we'll talk about more in the fiscal policy chapter. Then that gets us to panel C. The money supply is going to increase, causing interest rates to drop. As interest rates drop, we go back to this first panel A and we see that aggregate demand increases. Your book also talks about what happens with the exchange rate, which we're not going to get into too much detail here. But if you are interested in exchange rates and the price of bonds, definitely read this chunk of the chapter in much greater detail. So we are mainly concerned with panel A and panel C. They can also do contractionary monetary policy. So they're trying to shrink the economy. We are producing somewhere beyond that long run potential, and we want to decrease economic activity. Right? So the goal is to decrease aggregate demand and close an inflationary gap. So the economy has expanded past that long run level of real GDP, and the economy is experiencing high inflation. So contractionary policies, they're going to sell Treasury securities. This is going to decrease the money supply. This is going to increase interest rates, which is then going to decrease aggregate demand. For the same reasons as we saw last time. So higher interest rates mean it's more expensive to borrow money. It's going to cost me more to buy a house or a car. It's going to cost my business more to invest. It means my profits in the future are lower because I'm going to have higher costs. It also increases the opportunity cost of saving and spending. So if you see that you have at your bank, you can earn 4% interest on your savings account, and you spend all of that money now, you're not going to be earning anything, right? So higher interest rates incentivize people to save more. They're going to raise the discount rate. So they're going to charge banks more for borrowing. So they're going to want to keep more reserves on hand because they're not going to want to have to do loans. It's going to raise the reserves on interest rate. So they're going to pay more for saving. This is going to incentivize banks to keep more of their reserves at the Fed rather than lending it out to customers. So contractionary policy would be quantitative tightening. This is where you decrease the money supply by reducing the Fed's assets. Sometimes this is also called balance sheet normalization. Okay, so here we can see that again. So panel A, we have an inflationary gap, right? We're starting over here where we're producing beyond that long run potential. So they want to decrease aggregate demand. So they start by selling bonds. When they sell bonds, that moves us into panel C, where the money supply decreases. This causes interest rates to go up, and the new higher interest rates shift aggregate demand to the left, getting our economy to that long run equilibrium. You can also see here what happens in the market for exchange rates, so please do more in diving into that if you are interested in exchange rates. Okay, so that is the end of our discussion here on monetary policy. Please let me know if you have any questions on how to calculate this stuff or figure out what's going on, and I will talk to you next week.